Welcome to The Explainer. Today, we're diving deep into NVIDIA's absolutely incredible 10-year evolution. And we're going to objectively look at the hard math behind its stock right before tomorrow's critical Q1 FY 2027 earnings report. Now, if you follow the markets at all, you know NVIDIA isn't just a company anymore, right? It's literally the poster child of the entire AI revolution. But our job here is separating all that hype from the cold, hard financials.
Okay, so here's our roadmap for today. We are going to cover 1. A decade of pivots. 2. The unstoppable growth engine. 3. Moats, tailwinds, and risks. 4. The valuation reality check. And finally, 5. The pre-earnings verdict. We're taking this from the historical hype that built this $5.5 trillion titan straight into a strict, totally unemotional financial reality check.
To really understand the stakes today, we've got to start with this absolutely staggering number. A total return of over 20,000% over the last decade. I mean, just let that sink in for a second. We're talking about a stock that, when you adjust for its multiple splits, including that massive 10-for-1 split, went from basically $1.05 back in May 2016 all the way to the $220 range today. That's a 70% compound annual growth rate for the stock price. Pre-2020, it was just in this long consolidation phase, and then boom, a massive breakout in 2023 tied directly to the explosion in AI spending. But, how did they actually pull this off? Well, let's jump right into Section 1. A decade of pivots, from gaming to AI infrastructure. So NVIDIA's evolution really breaks down into 4 distinct eras. Back from 2015 to 2018, they were mostly known for gaming graphics, kind of riding the wild volatility of early crypto and early machine learning. Then, between 2018 and 2021, the whole narrative shifts. Data center AI emerges as this massive pillar, and their CUDA software ecosystem quietly becomes the total industry standard. Fast forward to 2022 through 2024, the era of ChatGPT and large language models. Their H100 GPUs fueled this entire wave, and they pulled off this brilliant pivot to selling entire systems, like these massive networking racks. And now, 2024 to 2026, it's all about the Blackwell architecture, sovereign AI factories, and get this, humanoid robotics like Project GROT. They went from making your video games look pretty to literally building the infrastructure of the future. Crazy, right?
Which brings us perfectly to Section 2, the unstoppable growth engine under the hood. Because honestly, the numbers here are almost hard to believe.
The financial acceleration we're seeing is just staggering. Listen to this. 10 years ago, in fiscal 2016, NVIDIA generated about $5 billion annually. And hey, that's a great business, for sure. But by fiscal year 2026, which ended in January, that number exploded to a massive $215.9 billion. That implies a 44% compound annual growth rate over an entire decade. Their data center revenue is so dominant now, it makes those old gaming numbers look like a tiny rounding error.
But here is what's truly wild. NVIDIA is pulling off software-like profitability on physical hardware. They're generating an elite 71% trailing 12-month gross margin, and their net margins are pushing past 40%. But the real jaw-dropper? 101.5% return on equity and an astonishing $96.7 billion in free cash flow. Plus, they're sitting on a fortress of a balance sheet with roughly $62 billion in cash. This right here is the textbook definition of a world-class growth engine comfortably funding its own massive R&D without even breaking a sweat.
Of course, to stay perfectly objective, we need to look at the whole picture. So let's move to Section 3, moats, tailwinds, and risks balancing the scales. Because let's be real, nothing goes up in a straight line forever without some friction.
There is a massive tension right now in their business. On the left side, you've got this incredibly deep moat. Millions of developers are totally locked into their CUDA software ecosystem. Combine that with their NVLink hardware integration, and they command an estimated 70 to 95% of the AI accelerator market. It's huge. Plus, the hyperscalers are throwing hundreds of billions at them in CapEx. But look at the right side. The risks are just as real. US-China export restrictions are a constant threat to revenue. Big tech customers like Google and AWS are literally building their own custom silicon, or ASICs, to compete. And then there's the looming threat of a CapEx digestion pause. A moment where companies stop buying chips just to figure out how to actually profit from the massive pile of chips they just bought.
Okay, with the business fundamentals laid out, let's step right into Section 4, the valuation reality check, math over emotion. This is where we separate the great companies from the great investments.
Before we look at the exact numbers, here's how we're breaking this down. We're using Philtown's Rule Number 1 methodology. The goal is super simple. Find wonderful companies, but only buy them at wonderful prices. That means we have to figure out the intrinsic sticker price based on long-term growth, and then we demand a 50% margin of safety. We also want to check the payback time, which is basically how many years it takes for the company's cumulative earnings or free cash flow to essentially pay you back for buying the stock. Ideally, we want to see that at 8 to 10 years or less.
So when we actually run the math, things get pretty challenging at the current $220 price tag. If you look at our conservative model assuming 15 to 20% long-term growth, the intrinsic sticker price maxes out around $190. That means the stock currently trades at a premium to its fair value, and it's miles away from that $46 to $95 margin of safety buy zone. To justify the current valuation, you need highly aggressive, sustained 25% growth over the next decade just to push the current $220 price into a buying zone. And let me tell you, sustaining 25% growth for a $5.5 trillion company, that is a monumental task.
Furthermore, even under that highly optimistic 25% sustained growth scenario, the payback time sits at over 14 years. That is well beyond our preferred 8 to 10-year threshold. So by strict Rule Number 1 standards, NVDA is undeniably a wonderful company, but it just isn't a classic bargain today. It definitely sits in that fair to expensive territory. And get this, if you were to assume zero growth from today, that payback time explodes to over 40 years.
Bringing all of this analysis together, let's look at Section 5, the pre-earnings verdict, the stakes for tomorrow, because the entire market is going to be watching this one closely.
Look, NVIDIA is undeniably a global powerhouse with elite execution. But tomorrow, right after the market closes, investors are going to be rigorously testing 3 specific factors to see if this massive engine can maintain its momentum. Step 1. How is the Blackwell architecture ramping up? Any hiccups or delays there could seriously spook the market. Step 2. What is the forward demand visibility? Are the hyperscalers still spending aggressively, or are we starting to see a pause? And Step 3. Check for any compression in those elite 71% gross margins. If competition from custom chips is starting to bite, it is absolutely going to show up in the margins first.
Ultimately, your view on NVIDIA's valuation comes down to this single conviction call. The company's fundamentals are explosive, no doubt about it, and its moat is incredibly deep. But as you watch the earnings drop tomorrow and brace for the inevitable market volatility that follows, ask yourself this: is the AI supercycle truly durable enough to justify sustained 25% plus growth for the entire next decade? Thanks so much for